Hi, I'm Jeff, the mayor of Valuetown, and this is the most important video that I have made so far. My motivation is simple. I want you to gain lots of value in real life. And so, this video is a little bit different than my usual video. So if you enjoy it, if you find value in it, then give it a like. Recently, I attended a party, and initial topics included crypto and meme stocks. Now, I actually thought that was awesome because it meant that a lot of my friends were interested in investing, and I had already gotten interested in investing through this individual stock hype movement as well. So I spent the last half year learning everything I could about investing. That said, though, I had already known that in order to even invest in these really risky things, that you needed to have an extremely strong foundation already. And I feared that my friends were skipping a few of the steps of personal finance, the steps that you have to get to, the steps where you build a lot of value before you get into this really risky investment thing. I wish that personal finance were a course that was taught in high school. I think it's essential, I think it's fundamental, but sadly, most people don't get that course, me included. Fortunately for me though, I'm the mayor of Valuetown, and I've always lived a life of maximizing value. Why? It's because I'm lazy. Laziness is a trait that has come to my advantage in this case. A lot of lazy people realize that the way that they can be lazy is that they pinpoint something really important that they need to focus on so that they can slack off in other places. That's the one place they can't be lazy. Now, let me tell you what that part is. That is personal finance. In this way, I agree a lot with the FIRE movement. That's financial independence, retire early. The FIRE movement encourages you to save and invest aggressively so that you can retire early. Now, of course, you don't actually have to retire early. I think of it more as so that you can pursue whatever you really want to do. I, for example, started to make videos on computer games and now investing. In that fashion, I think that personal finance and FIRE really do go hand in hand, where I think going through my definition of 7 main steps will lead you to being able to take it easy on the final step and essentially retire. Now, just because it's 7 steps doesn't mean it's going to be easy. In fact, a lot of the steps are hard, they're long, they're going to require you to make sacrifices. However, I think everybody should pursue going through these steps and not to skip steps, because each step that you go down builds a stronger and stronger foundation. Now, what I really want to see is people joining me in the final step where their money is working for them and they can afford to be taking it easy a bit more. They can afford to do what they really want to do. So that's what I'm going to do in this video. I'm going to walk through the 7 steps, first time really quickly, second time in a lot more detail, so you can see where you should be every step of the way. And everyone starts off in a different step. Some of these steps I'm going to be talking about specific United States tax and retirement accounts. However, across a lot of countries in the world, there are equivalent accounts. So if you're not in the United States, this video does still apply to you. Just figure out what the equivalent account is for your country. Now let's get started. Step 1, create a budget with monthly income and expenses. You need to know where you're getting money and where your money is going. Step 2, build an emergency fund. To start, a month's worth of expenses is a good goal to build to. Later, grow it out to 3 to 6 months worth. Step 3, start investing under the most favorable terms. If you're working at a company with a 401k match, then invest up to the amount that your employer is matching for. Step 4, pay down your high interest loans. Credit card debt and personal loans are the big ones. Step 5, invest into your IRA, individual retirement account. Contribute up to the limit each year to this tax-advantaged account. Step 6, it's back to your company 401k. The remaining amount you can contribute won't be matched, but it's still a good deal since you invest pre-tax. And step 7, more investing. This is the part where you invest in non-retirement accounts so you can grow money that can be used even before retirement age. So that was really fast. Now I'm going to run through this again using the personal finance subreddit Flowchart created by Atlas Void. It's been a really great resource. It's been in use for over 5 years, and I've just made a few adjustments to it. Let's run through it. Step 1. Create a budget. Write down where you spend all of your money. The most common expenses are housing, food, transportation, insurance, debt, entertainment, and the monthly bills from utilities, phone, and other subscriptions. If the majority of your income is going to these categories, looking at cost savings is essential to increase the amount of money you can save, pay down debt with, and eventually invest. I think it's useful to see sample budgets to check how yours compares. You can find some on Refinery 29's Money Diaries, link below. The start of the personal finance journey is simply survival. You need shelter, so you have to pay rent or mortgage. You need to eat, so you have to buy food and groceries. You need basic necessities, so you need to pay the bills so you have power, water, and heat. You need to make sure you make money, so paying for things that allow you to make money such as transportation, internet, and phone come next. Your health is very important because dying or going bankrupt through medical bills is bad, so pay for your health insurance. Make the minimum payments on all the debts accumulated. I moved the next node compared to the original flowchart. I recommend paying non-essential bills before building your emergency fund. What is correct, and perhaps what they meant, was that if you don't have an emergency fund, you should trim whatever is not essential and go back to adding more in after you've built up your emergency fund a bit. Step 2, build an emergency fund. A small emergency fund is critical because life throws you curveballs. It's a relief to know that you can still afford to pay expenses if you suddenly lose your job. Just the knowledge that you can pay your bills without having to check your bank account is a huge relief. Put that amount of money that you calculated in step 0 into a checking account at your bank. And as you grow your emergency fund, add additional amounts into your savings account. Step 3, start investing under the most favorable terms. You might be surprised that investing comes this early in the flowchart, even before paying down your credit card. The 401k match is such a good deal that yes, it's worth paying some interest on your credit card if you have to make the choice for one or the other. Ideally, you do both at the same time. You have until the tax filing date, April 15th of each year, to contribute to your 401k. In many companies, you can choose either a Roth 401k or traditional pre-tax 401k. 401k plans offer you tax savings, and you don't have to pay any capital gains taxes on your investments, which have increased in value. If you're in a low tax bracket, the Roth is likely better. You'll pay the taxes you owe now at the low tax rate, but when you retire and take out contributions, you will owe no taxes on the money taken out. If you're in a higher tax bracket, the traditional is likely better. Money contributed to the traditional is pre-tax. You will end up paying less in taxes now, but when you retire and take out contributions, you will owe income taxes on the money taken out. Which plan to choose does depend on each individual circumstance. More information below in the info with a link on deciding whether to have a traditional or Roth 401k. So what's the catch? You can't withdraw money until you're the retirement age. Currently 59.5, but that age could go up later. Your 401k will have a few fund options in it. I believe the best stock funds are ones with a low expense ratio, which invest in a lot of companies. Good examples of these are the Vanguard Total Stock Market Index, Vanguard 500 Index, Vanguard Institutional Index, Vanguard Total International Stock Index, and Fidelity 500 Index. These are common holdings in 401ks. Depending on your age, you may also want to pick up a bond fund, such as the Vanguard Total Bond Market Index. Now, you're not always going to have funds like these, so hopefully there are going to be similar ones. I'm allocated 100% stocks and 0% bonds. However, as you grow older, you're going to want to increase your amount of bonds in your mix of stocks and bonds in your portfolio. Having just 1 or 2 stock funds, plus possibly 1 bond fund, is enough. No need to get fancy. Having the Vanguard Total Stock Market Index plus the Vanguard Total International Stock Index Fund means congratulations, you're invested in just about every public company worldwide. On the Valuetown show, those are the 2 funds I invest in, at an 80% and 20% split. The 401k aligns well with what I believe investment mentality should be. It's not to get rich fast. It's to set yourself up so that when you are old, you can relax and be lazy. And if you do it really well, you can set it up so that when you're middle-aged, you can relax and be lazy. For now, on this step, just contribute the amount that your employer is willing to match. This is the best deal you'll ever get, an immediate return on your investment. It's essentially free money. Worth mentioning as well, some employers also match health savings account funds. If they do, then this is also the part to start funding your health savings account. More information on that on a later step. Step 4, pay off high interest loans. To keep this broad and relevant, because what high interest is varies over time, I'll give you my definition of high interest. It's 5% above the risk-free interest rate. I use the 10-year Treasury bond rate as that risk-free interest rate. To figure out what that is, Google for 10-year government bond rate. As an example, if that rate is 1.5%, as it happened to be at the time of this video, that means anything with a 6.5% interest rate or higher should be paid back as a priority. Once you're done paying off your high interest loans, start expanding your emergency fund to 3 to 6 months of expenses. 3 months is sufficient if you have great job security and feel confident that you can find another if you do get laid off. Building up to 6 months is recommended if you feel less confident. If you like pushing the limits, 3 months is also more acceptable if you're further on the flowchart, because you can sell stocks to pay for things if you really need to, though that isn't ideal. Next, any medium interest debt that is more than 2% above the risk-free rate should be paid. In the case of the 1.5% risk-free rate, anything with 3.5% interest rate and above. Student loans might be an exception because student loans might be forgiven by the government. Additionally, you may be able to refinance your student loans and get a rate that is no longer medium interest and is instead low interest. If you have a mortgage, that interest rate certainly shouldn't be a medium interest rate, and if it is, you should refinance it into a low interest rate. These low interest rate debts can be kept because generally your investments will outpace the loan costs. There are 2 main methods of paying off loans. One is the avalanche method, and one is the snowball method. The mathematically better way is the avalanche method, in which you pay off debts which have the highest interest rate first while making minimum payments on the rest, so that you pay the lowest amount of interest. However, we're humans, and psychologically, the snowball method may be better suited for you, where you pay off the smallest dollar amount debts first to get them out of the way and give yourself some wins, allowing you to more readily see the progress you're making as you knock down one debt after the other. I'd like to mention specifically that you definitely should not take out moderate interest loans to invest with, because investments are inherently risky, and while on average the S&P does make 6 to 10% annually, that is an average over a very long period of time. In the short term, stocks can crash and ruin you if you're borrowing money to invest. Depending on the amount of risk you're taking, and if you're getting into the fervor of memes and crypto, it may be as insane an idea as borrowing money to bet that the ball lands on black on the roulette wheel. Step 5. Invest in tax-advantaged accounts, IRAs, individual retirement accounts, and HSAs, health savings accounts. Just like the 401k, there are 2 main types of IRAs, Roth and traditional pre-tax. They offer you tax savings and you don't have to pay any capital gains taxes on your investments, which have increased in value. They're such a great deal that I recommend contributing the maximum each year. The amount you can contribute changes each year, so look up the amount that you can put in. If you do have a 401k and you are contributing to it, then there are limits to how much you can be making in order to be able to contribute to an IRA. Like the 401k, Roth IRAs pay tax now and don't pay taxes on distributions post-retirement. Traditional IRAs are pre-tax, but you pay income tax when you take distributions post-retirement. Again, if you're in a lower tax bracket, the Roth is generally better. Which plan to choose depends on each individual circumstance. More information below. In the original flowchart, the HSA was actually lower, but it's been moved up to here, and in fact, if your company matches it, it should have been even higher than this. Your company might offer a high deductible health plan and HSA. HSAs also have a maximum contribution and have an even better tax advantage than IRAs. HSAs have a triple tax advantage. Your initial contributions to the HSA are not taxed, you don't pay taxes on the investment income, and when you take out the money, you also don't pay taxes. You're allowed to pay for any qualified health-related bills with your HSA. Additionally, you can pay these bills normally and just save the receipt, reimburse yourself much later. This allows you to keep your money to grow in the tax-advantaged account, even with investing it. Some of the best investments you can make are investments in yourself. College, certifications, even a car could be an investment. These investments could make you earn a lot more money. These could cost quite a bit of money, but if they're required or investments in yourself, they're likely worth it. Small caveat that there are some overpriced courses out there, often related to investing, that you can find cheaper or for free. Do your research before investing in anything. Step 6, back to your company 401k. Money you put into your company 401k has the downside of being a bit more limited. However, not having to pay taxes now on income and not having to pay capital gains tax is tremendous savings. While the general recommendation is to save at least 15%, you can invest even more aggressively, up to, in 2021, the limit of $19,500 total. This total amount does include the amount you've already put in from step 3. Step 7, extra investing. This is the part which the FIRE movement and myself rush towards. The more investing you can get done at an early age, the faster you can retire early. And retirement, again, doesn't necessarily mean quitting for good. What it means is that you can pursue whatever you want to do. The money you invest earlier compounds more and grows to staggering amounts. The rule of 72 is a shortcut to estimate the number of years it takes to double your money by dividing 72 by the annual rate of return. So if you use a rate of return of 8%, then your money doubles every 9 years on average. Therefore, if you're 30, then 36 years later, 4 doubling periods at the retirement age of 66, any money you had put in at 30 undergoes a 16 times multiplier. Anything you manage to save at 21 gets multiplied by 32 times. Compound interest is truly a miracle in providing value. For the majority of people, just put your money into low-cost index funds, which cover a lot of companies. I listed the names above in the 401k section. These funds also have ETF equivalents, exchange-traded funds. On the Valleytown show, the portfolio of low-cost index funds as ETFs that I own are split 80% into VTI, Vanguard Total Stock Market ETF, and 20% into VXUS, the Vanguard Total International Stock ETF. Just keep contributing to it and don't worry about market ups or downs. That simple strategy outperforms the average person. You just have to have the gut, the stomach, that when your portfolio goes down, that you don't panic sell. And if you think you can time the market, you can't. For the very ambitious and those who just have an itch for investing, you can take some of that money, maybe 5 to 10%, and make individual investments like I do on my Valleytown Fund show. There's so many investments you can make, ranging from blue chip stocks, which are the biggest companies out there, to meme stocks or crypto. As long as you do your due diligence with lots of research on the stuff you buy and you're not taking too big a position in it, I approve. But make sure you do your research and make sure you actually know how to do research. Don't expect to beat the simple strategy of low-cost index fund investing, and the riskier a position you take, the higher chance you have of losing a lot of your investment. You made it to the end! This is the part where you secure your future. You can invest for your children's education, or save it for big purchases such as a house, or perhaps that vacation that you deserve for getting here. Investing should not be exciting. It's a way to generate value over the long term. If you want to try to get rich quick, it will come at an enormous amount of risk. And generally, that amount of risk isn't worth it. So that is personal finance in a nutshell. I tried to condense as much as possible into as little as possible. So hopefully that video got you some value. And if you enjoyed that kind of financial show, well, I've got a Valleytown Fund show where I evaluate a stock and I must take a position in it using funds obtained through Patreon, patreon.com/Valleytown. That link and a lot of other information about personal finance below. Now let's go make some money!